Well, good morning, ladies and gentlemen. Good morning, Frankfurt. Dear guests from various countries and regions, welcome to our 47th Food for Thought event in cooperation with the Association of Foreign Banks in Germany. A big thanks to our partner. Today, Frankfurt is again 1 hour ahead of London. Let's make the best of it. In the dynamic world of finance, digital lending has emerged a groundbreaking segment, revolutionizing the way non-banking lending operates. For SMEs, it has become a robust alternative to traditional banks for credit access. This transformation is fueled by the advent of technology-enabled channels that allow lenders to connect directly with specific borrowers, creating new vistas in private credit. Furthermore, additional digital lending as an asset class could significantly diversify and potentially enhance an investor's traditional asset mix, raising a crucial question. Is it a game changer for institutional investors in their portfolio allocations? In the midst of these exciting developments, we are honored to have Luca Frignani, the co-founder and CEO of our member Exaloan, joining us today in person here at the Frankfurt Main Finance office. At Exaloan, Luca is at the forefront of innovating lending through unique AI-based scoring models. His role encompasses directing the company's strategy, growth, and product development, particularly focusing on integrating data analysis and technology to refine business processes. Luca's academic background includes a bachelor degree from the European Business School and a master's degree from EDHEC Business School, where he specialized in quantitative methods. His professional journey has seen him cover roles from credit coverage at UBS to developing investment strategies at a startup, and later serving as CTO at Arbitrage Analytics in Zurich, where he implemented machine learning and AI in trading models. Notably, Luca also contributed as a research fellow at the Frankfurt School Blockchain Center, delving into the interplay of blockchain technology and AI. Dear audience, feel free, you know the procedure, feel free to pose your questions during or after the speech in the Q&A section in Zoom. Luca, welcome, the stage is yours.
Excellent. Yeah, thank you so much, Andreas. Thank you so much for having me on the show. It's really a pleasure to be here. And I'm very excited about sharing, my views about what's going on or what has been going on in the lending space, and how digitization is actually changing processes, and how it is driving, to an extent, disintermediation in lending, and therefore also reorganizing the space. So what I find really interesting about this trend is that, lending, which is predominantly known as a banking domain or a banking business, it is becoming accessible to a wider range of investors. And it therefore enables them to really power the real economy, as we say, with their investment capital. And you can really think of digitization paving the way and creating a new channel of financing for SMEs and also for individuals. And that explains a bit why we have chosen the title for this webinar, which reads obviously, democratizing lending and how digital lending enables investors to power the real economy. So, yeah. There we go. So this is the title of the webinar. Before kicking off, what we wanted to do for this webinar as well is to make it a bit more interactive. So I will cut my talk a bit shorter than what the audience or than what everybody is used to in this format. Because I will be taking about 15 to 20 minutes to talk about the market and how digital lending is reshaping the landscape. But we obviously also have Ate Weber from Chartered Investment in the audience today. And it's going to be great to also then have a bit of a discussion with him and also get his views on specific elements, especially around, the investment vehicles that can be used in order to make lending or digital lending more accessible also to investors. A few words, because all the audience may not be familiar with Exaloan, so allow me just a couple of words on who we are at Exaloan. In a nutshell, we're a fintech. We're specialized in digital lending and AI-based credit risk analytics. So what we do is we operate a global digital refinancing marketplace. What does that mean? Ultimately, we connect fintech loan originators, so platforms that enable borrowers to apply for loans online, with institutional capital, with institutional vehicles. And we do that with a unique set of self-developed risk analytics with which we actually strive for a seamless matchmaking between institutional capital and fintech loan originators. So you can think of us a bit as an Amazon for digital lending, except that we do not enable e-commerce or merchants to list books online and sell them to individuals, but we enable loan originators to list fundable loan applications on our marketplace, and then we do a matchmaking with the right investment vehicles. At the moment, we're working with over 39 different loan originators. That represents a pretty broad fundable loan origination volume of about 1.6 to 2 billion per year that is fundable. And we have collected a pretty unique data set of over 70 million loan records, including borrower data and performance data. So in terms of data set, that is probably one of the deepest that you can get in the sense of, European market coverage. And we have actually a pretty global reach in terms of the originators that we work with. So we operate across 3 continents, covering most of continental Europe. We have origination partners in Southeast Asia, as well as in the US. So obviously, I'm not here to talk about Exaloan, but I'm here to talk about digital lending. And I think it always helps to have a brief look where digital lending ranks and what kind of to which asset classes it is actually comparable. And the digital lending as such is part of the direct lending trend. So basically, digital lending is the tech-enabled or online part where institutional investors directly fund either small businesses or private individuals. So as such, here in the overview, we have made this nicely visual where we show, different asset classes on the well-known risk-return scale. And you see that, direct lending and private credit, it is a bit of a mix, and it sits in between traditional fixed income and equity. And the reality is that also when you talk to different investors about how they would classify the digital lending or the direct lending space, a lot of the answers and a lot of the classifications, they depend a bit on which investment vehicles are used. So the reality is that we see a lot of securitization also happening, basically investment banks securitizing granular loan portfolios that were assembled by fintech originators, and then issuing, for instance, even public securitization deals, where then those notes would be classified in the or as part of the more traditional fixed income market, while when you have, for instance, asset managers with a dedicated team that analyze, the larger middle market of businesses, and they then tend to extend larger tickets to SMEs and then wrap that all in a fund structure. Then you see these structures emerging more as part of the the direct lending or the private debt market. But overall, as you can see here, when you compare direct lending and digital lending with other asset classes, it becomes apparent that you're dealing with a fixed income-like instrument that has the potential to deliver equity-like returns. And as such, this has gotten, over the past couple of years, a lot of investors really excited about the prospect of adding this as an asset class into their portfolios, because then obviously while you are finding your asset mix or your optimal asset mix, then this has the potential to really move also the efficient frontier. So non-bank lending and direct lending or digital lending are major parts of it. So non-bank lending has been on the rise. And obviously over the past 5 years, there has been a true push for private credit, which we have seen. There was strong demand from institutional investors, a lot also driven obviously by very low interest rates, which has sort of changed since the middle of last summer. But nevertheless, non-bank lending has actually been in development and has been truly emerging as a new, almost platform-based ecosystem over the past 15 years. And what we mean with non-bank lending is actually that, you know, you have either direct lending funds, right, that extend credit directly to corporate borrowers, but you also have all of these fintech originators and a market that is actually that has its origins from the crowd lending space, right? So as an alternative to banks, a borrower, they can apply for a loan online, and rather than having a bank, you know, originate or disperse the loan and lend from its own balance sheet, you actually have a matchmaking platform that connects many potential investors that then extend credit to one individual or to one small business. And over time, so this has been ongoing for about 15 years. The pioneering platforms are based in the US, with Prosper being really the first crowd lending or digital lending platform, and then Lending Club and some others following suit, where this market has actually morphed from fairly small alternative origins to a really established segment. And as such, it represents a new investable asset class because, as mentioned, lending business is no longer something that is sitting within bank balance sheets, but it is actually, you know, a market that is evolving and that is growing outside of bank balance sheets. And as such, it is being democratized, as we say. It is becoming accessible to a wider audience or wider range of institutional investors. So let's take a look also from the borrower's point of view, because obviously, you know, if I go to my bank and I can get a loan, then there wouldn't necessarily be a very big incentive to try something new. But the reality is that a lot of SMEs are actually left in need of financing. And I want to make that example on the basis of the market in Finland. Because Finland is a Eurozone country, it's got a well-developed sector, so we would firmly consider it, you know, an established market. But we clearly see in this market that bank retrenchment is taking place. And in a market that has over 35,000 different SMEs, so small to mid-sized enterprises, the alternatives are actually rare, or it is very hard to actually get credit. And one of the main reasons why banks are not serving this SME segment or the SME market very efficiently is obviously, you know, capital requirements and regulations that are constantly tightening. The reality is also that, you know, unsecured lending for average borrow rates, it requires high capital costs, and the margins that you can get on the lending activity, I mean, they are fairly limited. And it is also true that, you know, for small tickets at some point, you know, the economics are just simply not there. With, you know, ROE targets of north of 15% for banks in the Scandies, you know, then banks tend to focus on capital efficient products, and they also tend to focus on the upper middle market. So really larger corporates and, you know, corporates with that are well known with better ratings, which then actually in reality leaves a lot of smaller businesses, even mid-sized companies with revenues between 1 to 50 million euros, you know, a bit out in the cold. And it certainly also doesn't help when you look at the corporate lending market structure in Finland, for instance, that, you know, over 80% of the market is actually dominated by 3 major banks. So there is not necessarily a lot of price competition. Getting credit is fairly expensive, and there is not necessarily a large incentive for established incumbents, banks, to serve this smaller scale, this more granular SME segment. And that is actually an opening that that is very attractive, or that is a very attractive entry point for alternative lenders when you're operating, without capital constraints, when you have digital processes, and you can also roll out to the wider mass market with a maximum of process automation, like a digital lending platform has, and with online applications. And this phenomenon that we're seeing here, that a large part of demand for credit is not efficiently served or underserved by traditional banks, that is a phenomenon that is actually occurring globally. And the World Bank is calling that the global financing gap for SMEs and micro SMEs. And the size of that global funding gap is actually $5 trillion, as estimated by the World Bank, which is, if you think of it as a macroeconomic problem, pretty significant. Because circling back to Europe, we have over 23 million SMEs that are registered in Europe, and these account for over 80% of the private sector employment. And that also means that the existence of the funding gap implies that the backbone of the real economy is actually struggling to get financing at affordable rates, or even getting financing at all. And it is actually not something that is limited to emerging markets, but it is happening here in the heart of Europe. So that's why digital lending and fintech originators have stepped in, and they serve a direct need and direct credit demand, and is also one of the reasons why it is growing very rapidly. So at the moment, the market on a global scale accounts for about 680 to 700 billion in terms of origination volume, but the growth is pretty significant. So the market grows at a compounded annual growth rate of over 30%. So if you project this out until 2030, the target market is actually going to become a pretty sizable part of the non-bank lending market going forward. So the question is, if this market is growing and it is lending, or the lending activity is happening outside of balance sheets, and it is such granular, very small loan tickets, is this market ready at all for institutional investors, particularly since it has its origins in the crowd lending market, where you actually have a retail investor base? And the short answer is yes. So institutional investors have, over the past 6-7 years, gotten more and more interested, and have actually funded larger deals in cooperation with fintech loan originators in a bid to actually enter this market. And so we have assembled here a couple of benchmark transactions. A pretty famous one, obviously one of the first really leading transactions here in Europe, was Aegon, a Dutch pension fund, that actually extended a 1.5 billion funding line to a German originator that is focusing on consumer lending and making credit more widely accessible to private borrowers. But you also see in the other deals that ticket sizes of 200 to 250 million, they are not necessarily a rarity. So the market is deep enough. There are enough funding opportunities in order to also satisfy institutional deal sizes. And most of these transactions so far, they have actually happened as securitization transactions that I alluded to. So very often in connection with investment banks like Goldman Sachs, Citi, and BNP, who actually then pooled granular loan portfolios in securitized transactions. And this is at the moment where the market is at. But the long story short is that it is accessible for institutional investors. It is by no means a very new kid on the block, but the first movers have already entered the space. And the way forward is more cooperation between fintech originators and established institutional investors. So looking at these transactions, looking at the fundamentals and the dynamics in the market, we can conclude, well, the market is interesting. It is definitely a very interesting value proposition also for the borrowers. There is awareness from the institutional side. So there is capital, there is a lot of demand. what makes it difficult to capture this market? In other words, are there any obstacles for institutional investors and originators to meet? And the simple reality is that digital lending, it is not something that is happening locally, but it is a global phenomenon. So the market is global, and it also means it is highly fragmented. So the dynamic growth, it is fueled obviously across different countries, across different continents. It is really fueled by the popularity of digital channels, by the popularity of e-commerce, rising internet speeds, more bandwidth, smartphone penetration, the popularity of e-commerce. All of these are actually trends that also lead to the fact that digital channels are emerging as the new way forward to engage with borrowers and to actually access credit. And if you look at the largest digital lending markets to date, are the pioneers is obviously the US, together with the UK here in Europe, but especially Southeast Asia is catching up very fast. And here in Europe, the major European digital lending markets are actually Switzerland, Germany, France, Italy, Finland, and obviously the Baltics. The question now is obviously also what are the effects of this fragmentation? So you can think of it as, yes, it is a global ecosystem. It has been evolving over the past 15 years. You have lots and lots of players. In fact, you have over 1,500 different fintech originators, and the number is growing that are operating across the globe. And the question is, so what are some of the incentives, or what are some of the effects? And the interesting bit that we also focus on with Exaloan when we make this connectivity between institutional capital and fintech originators is that, lending through digital channels, it has a pretty unique profile. So for that, we have actually looked at the cumulative default probability of the loans and compared it with the credit spreads for similar tenors with established fixed income segments. And what you can clearly see is that there are significantly higher risk premia to be earned in digital lending. And the question is, what is the driver of these risk premia? And the answer is it's not because the credit quality is worse, no. But these risk premia, the way we see it is they are actually attributable to inefficiency premiums. And it means that you have a fragmented market with over 1,000 different players, and you have a lack of visibility because there is no standardizing body. And the reality is also that a lot of originators target specific borrower segments, and that just leads to inefficient pricing and a lack of standards. And that means that if you are a bit on the cautious side, that you tend to overcharge the borrowers, and then the spreads charged to borrowers, they just overcompensate for the risk. So in that sense, it is actually a pretty attractive relative value opportunity in the sense that digital lending as an asset class can really be an interesting puzzle piece to add for institutional investors. And the relative value opportunity is not only in the sense that digital lending as an asset class is different to established fixed income classes, but there is also a second relative value opportunity in the sense of the word, because if you have thousands of different operators, each with their own credit scoring methodology, it then also means that the pricing is not standardized. There are no credit curves in that sense that we know from established fixed income markets. And that just means that this fragmentation, it also creates inefficient pricing. And to give you a sense about how big this inefficiency in pricing at the moment is, we have plotted the interest rates charged to borrowers from a single originator according to their score. And so from the left on the x-axis to the right, you see that the credit quality is increasing. So you have different credit scores for specific segments. And then each single dot, it represents a loan that was actually granted to a borrower. And you see that the dispersion within a column, the highlighted column there, the fourth one, it is actually almost 10%. So that is a huge spread, which means that, also this somewhat inconsistent pricing for borrowers of the same credit quality, but one borrower actually getting a loan for 6% and the other one for 16, that can also be exploited. And this is also what we do at Exaloan by standardizing the risk assessment and then making these funding opportunities comparable across originators, across jurisdictions. So this is a second very interesting proposition when you look at digital lending as an asset class. So having talked a lot about the market, the dynamics, its origins, let me make this also very concrete before actually concluding on a case study. And I have previously talked about the economics and the market structure of the Finnish market. So let me give you a direct comparison, very hard numbers on the digital lending and compare it to, traditional bank lending in Finland. And again, this goes back to the point of higher spreads that are charged to SME borrowers, but that effectively overcompensate risk and therefore represent a pretty interesting value proposition to investors who are thinking about capturing this risk premium. So in the top graph, you see the spreads or the interest rates charged to borrowers. So the blue lines are actually the bank rates, or is the corporate cost of borrowing from banks. And so this goes back from 2019 to September 2023. So obviously with very low interest rates, this was hovering at around 2%. But since mid last year, this has changed dramatically. So at the moment, the corporate cost of borrowing and the interest charged to traditional banked SMEs are somewhere around 5 to 5.5%. And the red dots and actually the line, the moving average that you see there, those are actually the spreads or the effective yields charged to SME borrowers that are served by digital lenders or digital lending platforms. And you see that the yield pickup that can be earned is somewhere around 700 to 950 basis points, which is actually quite massive. And that's simply because you are serving a market that is underserved by banks. So demand for credit by far exceeds the supply of capital, which then obviously at the moment, shows this inefficiency premium that investors can earn. But, and that's the second or the bottom graph that is showing, it is by no means that this inefficiency and this additional spread that is charged is due to worse credit quality. So when you look at, going back to the three banks, when you look at the NPL ratios, in traditional banks' balance sheets, then for the Finnish market, you have an average non-performing loan ratio of about 1.1, 1.3. It differs across different banks, so it's probably closer to 2% because OP is the local Finnish player and has the largest market share in Finnish corporate lending. So that is kind of the baseline loss given, or these are the baseline loss rates when you're lending to Finnish corporates. And when you look at the corresponding rates, so the loss rates for Finnish digital SME lending, yes, they are somewhat higher, but they hover at around 4%. So that means that the loss rates are probably somewhere between 300 to 500 basis points higher. But ultimately, that means that the spreads that you are earning, they way overcompensate actually the losses that can occur or that occur due to default. So that means for investors that position in the Finnish digital lending segment, they can get net IRRs of north of 10%, while when you are actually lending to corporates through banks or to more established companies, the net IRRs, net of defaults, would be somewhere around 4 to 5%. So this goes to show that investors can actually capture pretty attractive risk premia, while at the same time also doing something good with their capital, meaning they provide credit to SMEs, to the backbone of the real economy. And this is actually what we find very interesting. And this is what we strive to make broadly accessible for institutional investors with our refinancing marketplace. So let me conclude before we dive into the discussion with some of the key takeaways. Digital lending, it is the fastest growing segment within non-bank lending. It is a major driver to channel credit to SMEs, which form the backbone of the real economy and that are underserved by traditional bank lending. The reality is also that the digital lending market is a very fragmented one with over 1,500 different originators, and that leads to inefficient pricing. And the lack of standardization, it raises the need for efficient comparability for standardizing. And this is exactly what we're doing with our marketplace. And the borrower spreads that are charged to SMEs in the digital lending space, they overcompensate the credit risk. And that means that these risk premia, they can be captured and they can be a new source of income for institutional capital. So adding digital lending into the asset mix can be a pretty interesting value proposition. So disintermediation and digitization, they have disrupted small-scale bank lending. The market is projected to grow pretty significantly. But going forward, given that there is a large relative value opportunity, we firmly believe that there is also high value in cooperation, maybe even between banks and digital lenders, but certainly with larger inflows that can be expected into the digital lending space from institutional pockets.
Okay. Thank you, Luca, for this very comprehensive introduction. I'm very thankful that it didn't take the estimated 15 minutes, but it took 30 because it was really helpful for me. I'm not an expert in SME lending, so I found it very helpful that you extended this and also had some very nice examples. Of course, as we know a lot about the product now, digital lending, it is also interesting to know about the packaging, because the packaging is part of the value, I would like to say, and therefore we would like to have someone on board here in this webinar who is familiar with packaging. And among our spectators viewers is Ate Weber, who works for Chartered Investment and who is involved in this packaging as I might say. Of course, we do have some questions concerning his role and how he's working with this. And I wonder whether he's in and whether he can hear us and whether we can hear him. So Ate, are you there? Can you hear him? Okay, we just
Can you hear me? I cannot hear you, unfortunately, but
okay, should be working now.
yes, can you hear me?
Yes, Ate. Hi.
Yes, hi.
Good to have you on the call. So just not to lose too much time on technical things. We're happy you joined today. And just as an introductory question, just tell us how can you present digital SME lending to be an investable product to investors?
Yes, good morning. Thank you for having me. Exactly. So Luca explained a lot about digital lending, about the opportunities that are there, and also explained that the market is very fragmented. So if, as an investor, you would like to get involved into investing in digital lending, it may be difficult to overcome some of the administrative burden that you would be faced with when investing directly with a platform. So there are many platforms out there. The ticket size typically is very small, especially if it's about consumer credit. SME lending may be a bit less cumbersome, but it's also not really big tickets. So for most investors, it is very easy or favorable to have a wrapper to invest into this type of product. So this is where we come into play. As a Chartered Investment, we offer the wrapping solutions for all types of different assets. And one of those assets can be digital lending. So we've done a pilot project with Exaloan, and that's the reason why I have been invited to tell something about the project, but also of the lessons learned from this pilot project. What we do is we operate a vehicle based in Luxembourg that can securitize certain assets, as said. In this case, it's receivables that are originated through different digital lending platforms that are acquired by us and that are refinanced by issuing notes. So the notes are bought by investors. The money that is being invested by the investors is then paid out to credit platforms, and in return, we become the legal owner of the receivables on the platform. So it's a really convenient way for investors because they only have to buy a single note. It's clearable, so it has an ISIN, it has a Wertpapierkennnummer, is the German word for the WKN, and it can be held in a custody account. And this makes it much more easier to invest for investors because it's then part of their a custody account. It's part of their standardized reporting. If needed, it can be transferred from one investor to another. So it has a lot of advantages. Using a Luxembourg securitization vehicle offers some additional advantages because each transaction is done from a separate compartment or cell or ring-fenced let's say sub fund. It's not a fund, but it's essentially the same use case. So there's no additional credit risk added to the portfolio. So of course there is a credit risk. That's the credit risk of the receivables that we buy. But when wrapping that pool of receivables, no additional credit risk is added for the investor. So as an investor, you only get the credit risk that you want. You're paid for that credit risk. Luca, of course, elaborately highlighted the opportunities that are out there. And then at the level of the SPV, no additional credit risk is added. And this is something which would be different if you do this from a bank balance sheet, because of course there's always the risk of the underlying portfolio. But if you do this from a bank balance sheet, you always, as an investor, run the risk that the bank becomes insolvent. And this is a risk which in many cases you're not compensated for. So it's unwanted credit risk. So we like to distinguish between the two types of credit risk. Mm-hmm. We do this from a Luxembourg, from the Luxembourg jurisdiction, because Luxembourg has a very firm framework, legal framework for operating SPVs and securitization vehicles. It even has a separate law, which is the securitization law, which provides a lot of guarantees or comfort to investors, so that they know that their money is, let's say, well protected, that the assets that are held in a certain transaction are separated from all other transactions. So if something goes wrong in a different compartment, and there's some let's say investment that is must be liquidated, it does not affect the pool of receivables that we hold in a different compartment. So in this case, it's number 52. As Luca is well aware, it's the pilot project that we did. We acquired assets from 2 different platforms. And the investor that backed the project has then acquired the notes issued by us. and can hold those in a custody account. So this allows us to, let's say, go through the mechanics. Of course, there is some paperwork involved, but the good thing for the investor is that the paperwork is not being done at the level of the investor, essentially, but it's outsourced, in this case, to our SPV, as we become the legal owner of the receivables. So we have to sign the contracts with the platforms, as we've done not only the pilot project with Exaloan, but also many other projects. We also have a lot of documentation in place with platforms, so we can leverage off that. Like I said, we are the ones signing the contracts with the platform, and it's not something that the investor has to take care of. So this makes things a lot easier.
Yeah, may I just jump in at this point, because paperwork is one thing, and I know this is bothering a lot of people when it comes to paperwork and stuff. Nevertheless, I thought that the most important thing is probably what is the interest rate spread or the interest spread, and the question is, if there is higher interest, normally there is higher risk. And how can this risk be managed, which is a question that goes to Luca as well as to you, about the selection criteria. How can you, by in the lending phase already try to minimize default risk, and what can you do in portfolio management? For example, can you manage risk within the portfolio by using certain different ways of development, that the risk of the portfolio in total is smaller than the added risk of the single credits, just as an example. So this is the question, whoever wants first.
Yeah. Of course, this is a very good and relevant question. The thing is that we, as Chartered Investment, only provide the wrapping. So whatever goes into the vehicle is being passed on to the investors. So that makes us a bit of like a pure securitization firm. Of course, the question that you ask is very relevant, and that is exactly where Exaloan comes in, because we need somebody to select the loans that are being acquired. Of course, we've done, like I said, transactions in the past where we invested directly with the platform, and then the platform sort of does the selection based on criteria that are passed on to us, or are prescribed by us, by the investor in our notes. So the investor is able to, let's say, give us a set of guidelines, which we then pass on to the platform. In this case, there is an additional layer, which is Exaloan, who then picks the receivables that they find most attractive. And before I hand over to Luca, I would like to add something. Of course, there are many platforms out there, and each of them have a different credit scoring. And from what we've seen in the past, the quality of the credit scoring varies a lot. So the added value of Exaloan is having somebody look over the shoulder of the platform and making sure that the credit scoring that is being done by the platform is, well, I wouldn't say it's checked, but based on the first filter that the platform applies, Exaloan applies a second filter and makes sure that the most attractive receivables are picked from the platform's offering. And that's what I would like to add. Over to you, Luca.
Yeah, excellent. Thank you, Ate. So I think this is the point that I alluded to. So we specialize in developing AI-based credit scoring models, which work independently of individual platforms, because as Ate rightly said, the space is so fragmented. There are a lot of different credit scoring models. You cannot compare one with the other. So we have developed our system, which works a bit like a digitized version of Standard & Poor's or Moody's, you can think of it. And what we do is, before a new loan or before a new receivable is actually added into the SPV, we perform a real-time credit scoring And then we match it with the risk criteria and the selection criteria, or the eligibility criteria that are defined by the investor and then passed on to Chartered. And we make sure that these implementation criteria or these eligibility criteria are actually upheld in real time. So it may sound a bit like sci-fi, but it actually works pretty well.
So there is more to it than just creditworthiness, because you could use one of these agencies you mentioned, rating agencies, and use their credit ratings if there are any. But is there, what else is going into? Because AI is always an interesting thing to talk about. In many cases, it is a black box. So can you put some light into this black box of what you put in on the data side?
Yes, of course. So actually, the interesting bit is that by having the loan application by the borrower, filled out online, and being actually the whole data set on the borrower and on the underlying application being digitally available, this can actually, on an anonymized basis, be made available for us for processing. So that means in the same second as that the loan originator actually pushes the loan application onto our system, we actually get the loan information, the borrower information, the application, and that is a whole set of, depending on the originator, 80 to 120 different data points that actually go into our credit scoring model, and which then yields our credit score, which is based on a probability of default. And before then, before setting up this fully automated round trip and this fully automated process, what we actually do is we obviously need to calibrate our models to each originator that is on our marketplace. So we perform a pretty comprehensive due diligence. There is an entire onboarding process where we really look at the origination track record of the originator. We look at the loan types. We look at the financial statements. We look at also the IT side of things. So it takes about 4 to 6 weeks for a new originator to be able to be onboarded on our marketplace, so that we can actually provide this, as Ate said it, this second pair of eyes on behalf of the investor on a loan by loan basis in real time.
Okay, thank you. You mentioned interest rates, and I think this is we have seen the rising interest rates during the last 18 months, and so it is interesting maybe to have a look at how this change, what was a change to this business model. So on the offering side as well as on the investor side. So has the demand for these type of products has it exceeded your expectations, or how did this develop? So maybe both of you can tell what happened during the last 12 to 18 months.
So I can maybe start with the originator side and what we've seen with spreads happening. So obviously there is a bit of a time lag between private markets and public markets. So what we have definitely seen is that originators and the loans that were granted to borrowers, they haven't been as quick to adjust as public markets in terms of interest rates. There is usually a 1.5 quarter delay. But you definitely see also the increasing interest rates being passed on to borrowers, so that the spread that I mentioned is fairly constant, you can say.
Okay. So what about the investors? Has this product become more attractive in the new interest era, or what has been the development in recent months?
Well, I would say that it's still, let's say, a market that is growing very rapidly. Of course, it's becoming part. I'm just providing some broader context. This is becoming part of the strategic asset allocation of large investors. So there is money that has been allocated but not invested yet for a few months or even years, because it still needs to be implemented and it's coming to the market. So the interest is there from the investor side. Regarding interest rates, I have the impression that, like Luca said, the increase in interest rates for direct lending is going slower than the increase in interest rates for bank lending. And in my opinion, it hasn't quite caught up yet. So the interest rates for direct lending have gone up less than for bank lending, which reduces the spread for the moment. And of course, it'd be interesting to see how things develop going forward. In my opinion, however, there is a let's say caveat, because the bank lending, the banks are now charging higher rates, but I have the feeling, without having firm data on this, that banks are less keen to lend money. So if they do lend it out, they do so at a higher rate, but they're very zurückhaltend is a German word. They have a quite restrictive credit policy at the moment. So rates are going up, but at the same time, the volume is at least it's not going up, in my opinion. So the opportunity is still there, and I think this will also provide the digital lending platforms to increase their interest rates further as borrowers that need to finance whatever they need to finance are really well, I wouldn't call desperate, but they're really eager to refinance their positions and are looking more at direct lending.
Thanks. Yeah, we were talking about the future just a little bit already. So I was wondering, how mature is this market? How much experience is there already for originators as well as investors? And what is the expectation? So what is the expectation in relying on the interest rates, or depending on the interest rates? And what is the expectation if we see digital lending as an asset class in itself? So maybe you both have an opinion on that one.
Yeah, sure. I mean, so we clearly see that you know, digital lending, it is becoming, as part of, you know, direct lending, a more established let's say piece in the asset allocation mix for a lot of investors. Obviously, you know, the whole ecosystem around digital lenders or fintech originators, it is maturing. You can definitely see that. The reality is also that you know, the front runners in this market and the most mature markets are the US and the UK, with obviously the largest lending volumes going through platforms that are located in these countries. But we also see that the deepest pockets, so the largest investors in this space, they are also mostly Anglo-Saxon dominated. And you actually see at the moment that a lot of you know, a lot of deals that are happening with German originators or like, you know, continental European originators, they actually source the capital also from the UK or from Switzerland. And at least in our conversations that we are having with prospective investors, we see that you know, the Germany and Austria region, it has not yet caught up with, you know, existing investor awareness that already exists in the UK and its
Yeah, I agree.
Yeah.
So what I think is that as Luca said, the market is progressing, consolidating. However, it's still very fragmented. So I think there will be more consolidation. Like I said, the credit scoring models that different platforms use vary widely in quality. So I think there will be well, maybe not a shakeout. That sounds very radical, like a revolution. But the platforms that do not have an adequate risk management scoring system or credit scoring system in place will not grow, whereas others do. So this is going forward, I think, something which will shape the market. The market is, like I said, it's growing, so there will be a lot of growth opportunities for all the platforms, even the ones that maybe not have quite as good a scoring model as the other ones, but the ones with good scoring models, with a broad opportunity to originate new loans, they will grow much quicker. So there will be a consolidation with the big names, in my opinion.
Okay. Well, we'll see what the future brings. The good message that I can take as a representative of the Financial Center Frankfurt is that we again have this case of a coexistence and cooperation of fintechs and established banks, and the digital and traditional lending as well will have their share in the future. Maybe the percentage may be to be discussed, but in general, I think this is a very good addition to what we have seen in the recent years. Yes, I thank you both. I think it's almost 11, so this is the hard cut we always do at this point. I thank you both for your explanations and for your for the arguments and also for the brief discussion we had. And I think we answered the questions so far. Whoever is interested in a more deep conversation is happily invited to join you or to get in contact. Thank you, Luca, for being here in the studio, and thank you, Ate, for being online. So this is the first time we did this, but hopefully not for the last time, so we can bring more people into this format.
Excellent. Thank you so much. It was a pleasure being here.
Thank you. Thanks for having me.
Thank you all. Have a nice day. Bye-bye.
Thank you. Bye-bye.